Hey guys, Casey here. Welcome back to another episode of Lions Den Investments and Reviews. Today is Friday, TGIF. Hope you guys are ready for the weekend. But with that being said, I came across an article yesterday on one of the news channels, and it was about the stock market being basically overvalued, extremely overvalued from what it was like, say, back in 2008. So I wanted to go through this article real quick and just explain why I think stocks being overvalued. There's a different strategy that you can use, and this kind of goes into my investing plan for 2021 and what I've been doing basically this entire year since the pandemic started. So it'll definitely make more sense as to why I'm doing what I'm doing and why I'm covering a lot of material on other aspects of investing rather than just focusing in on the stock market. So getting started here, I came across this article from CNBC, and its title was "Nightmare: U.S. Stock Valuations Driven by Young, Dumb Investors." Fund manager says. Okay, so it's pretty interesting. At present, basically the key points on this were at present investors are paying 22 times forward earnings to purchase stocks on the S&P 500. That's 50% higher than the 10-year average valuation across the index. Not good. The other key point was much of the market rally, which took the U.S. benchmark from the correction territory in March to an all-time high in August, was driven by tech mega stocks and a bullish options market. Okay, I'll leave a link in the description below for this article so you can you can go over that and read it. Basically, what they're saying is U.S. equity valuations have become a total nightmare, fueled by young and dumb investors, according to Cole Smead, president and portfolio manager at Smead Capital Management. Um, he goes on basically to say, the forward price to earnings PE ratio divides the current share price of a company by its estimated future earnings per share. Okay, so just to break this down for you, you might want to get a pen out and write this down. And I got this information from Warren Buffett, from some of the books that he's wrote on PE ratios and what's considered fair value, undervalued, and overvalued. So basically, it's on a scale, okay, from like 1 to 20 on PE ratios. Anything under 10 on a PE ratio scale in a market that's not distorted and being injected with capital from the Federal Reserve. In a normal market, undervalued would be anywhere between 1 and 10. Okay, fair value would be between 10 and 14, and then overvalued, of course, would be 14, on upwards. Now, see, here's the problem, guys. We've had all this funny money being pumped into the market from the Federal Reserve, and it's distorted fair price discovery in markets. Okay, so with that in mind, it's very hard to get a proper and correct valuation on stocks at the current moment. So you'll see if you go out and you look at some of these companies out there and you look at their price to earnings, the PE ratio, you're going to see a lot of them at like 20, anywhere from 20 on up to, I've seen some as high as like 45, 50. And the thing you got to understand is when you're buying stocks, okay, you need to take a step back, okay, because just like shopping for an item when you go to Walmart, if you look at the price on a product that you're looking to buy and you're shopping around, you're trying to find the lowest price possible so you can get the best deal, right? Well, it's no different with stocks. So if you look at these P ratios, you can kind of determine, not 100%, but you can get a good idea as to, well, is this a fair price? Is this an undervalued price or an overvalued price on the company that you're looking to invest in? You can do it, I believe, with overall broad markets. Um, I normally don't even look at P/E ratios for broad markets. I just look at charts on that kind of stuff, long term. So for like weekly and monthly charts, and just to give you an example, if we go to the Dow Jones right now, so you can see all the way back here in February of 2009, Okay, this was after the financial crisis. We got that funny money pumping in from the Federal Reserve, and you can see we literally for almost a decade have not um, fallen below this support line that we've got drawn out here. I mean, we fell through it once back in September of 2015, but look what happened. We bounced right back up, and we remained above that support line for, from 2015 all the way into January of 2020. And then we crashed down, okay, and it looks like we were heading into like a free fall basically. Um, because, here's the thing: when you got valuations on stocks being extremely overvalued like this, uh, it can't keep continue to it cannot continue to keep going up and up and up forever. Okay, so it's going to have to come down at some point, and that's kind of what I was expecting going into 2020, regardless of what's happening with the virus and the pandemic and all that. Um, but as you can see, we dropped through the support, and then I was expecting a dead cat bounce to roll us back over so that we would start probably consolidating again and going into a recession slash depression sometime in November, or even as early August. But as you can see, they just keep pumping it up. Okay, so to me that spelled stay away from stock market unless you really want to lose your money. And I think that's going back to the article. That's kind of what they're talking about here. Um, especially when they start referring to young people being dumb investors. Uh, I think, just my own take on this is that young investors don't, they go off of a lot of hype, rumor, that kind of stuff. And it's quite simply because your education system does not teach you about stocks. They don't teach you about these PE ratios. What do they teach you? They teach you English, science, math, stuff to get a job as an employee. They don't teach you anything about investing. Okay? So, yeah, of course, your young investors, people who are trying to invest or just getting started, of course, they're not going to know this stuff. They have to learn it on their own. But the problem is a lot of them are just like, hey, okay, Tesla's a great stock to invest in. Why? Because everybody's talking about it. Okay? And so they just, oh, okay, I'll just invest in Tesla. They don't look at the financial statements. They don't look at P ratios. So that's my take on why they're saying this. And it is very dangerous because along with the funny money that's being propped into the markets from the Federal Reserve, you get this too on top of that, and you get extremely overvalued, bloated stocks and an overall market index that is going to be crashing and coming down. And the bigger the bubble, the bigger the crash. Okay? The more money is going to be lost. And what they're saying here is basically they're buying bullish call options that expire inside 2 weeks. Um, he goes on to say there was 500 billion of bullish call options bought in a 4-week stretch by small retail traders. That's insane. Like, that's crazy. Like, you're talking options. Options are, for more advanced day traders. It's not really for investors. Investors are people who buy something because they believe in the product, right? And they hold on to it long term. It's more based on a belief system that, hey, 10 years from now I'm going to get a good return. Call options, on the other hand, are real short term. They're super high risk. You can leverage yourself. You can leverage yourself to the tilt. Like big time. The more you're leveraged, the more risk you're going to take on. Okay. In 1999, they're saying those call options that we're talking about here were at 100 billion instead of 500 billion. That is what young dumb investors are doing, and when the market makers see those call buying signals out there, they sell that call to the person that they buy this, and then they buy the stocks. Okay. He suggested that the willingness of wealthy investors and the baby boomer generation to ride the next index to a fault and overpay for stalwart American businesses such as Costco and Microsoft. Basically, he goes on to say here, Microsoft is a wonderful company, but right now it's at 40 times earnings. So it's overvalued 40 times what its considered fair value price is. So I thought that was interesting. And this kind of goes into my investing plan for 2021 and why I've been covering other investment vehicles that are out there, because the number one rule to investing, guys, is don't lose your money. And then, according to Warren Buffett, rule number 2 is don't lose your money. Follow rule number 1. And if you don't want to lose your money, well, you don't want to buy stuff that's overpriced 40 times what it should be going for on markets, right? So you want to stay away from that, and you want to look at stuff that's undervalued. Uh, with a market like this where all this cash is being injected that's not worth anything, it's not backed by anything, and you've got fair price discovery mechanisms distorted, you have to go somewhere else. And that's why I've been covering blockchain and cryptos, because you can still get into those markets on stuff that's completely undervalued, and you don't have to worry as much about the price distortions because you're not having to worry about manipulation from the central banks as much as you do with the stock market. Okay, they control this entire system when it comes to the stock market. On blockchain and cryptos, for instance, it's a little harder for them to control that. They can throw money at it all they want, but they cannot control the hash rate in which these blocks are created on the blockchain and provide, new data and new value to some of these projects. So that's why I look at blockchain as an investment tool, because at the end of the day, it's all about getting a return and trying not to lose your money. Okay, so my investing plan moving forward for 2021 is to keep doing a lot of that, like investing in blockchain. I'm completely out of stocks. I got out up here at the very top because I knew it was coming, so I didn't lose anything. Yes, we rebounded. I could have got back in down here and rode it back up, but I just see where things are headed. I would much rather put my money somewhere else where I can get 800% returns like I have with a couple of the blockchain investments I'm in right now, and that's for the year. If I would have went into the stock market here, yeah, I probably could have got that as well, but the odds were against me. So it's another thing I'm going to tell you. Look at your odds. If your odds are in your favor, then you might want to think about, taking a second look at the investment. And who knows how much longer this is going to continue for. It could go for another, 2-3 years. But I'm expecting when it does start coming down and we go into another recession type depression event, you're going to get more of the same. The Fed's going to continue printing money, which is just going to devalue the value and purchasing power in your back pocket of that US dollar. And you want to be hedged against that, okay? So silver, gold, cryptos. Warren Buffett even right now has went in on Barrick's Gold and started owning Barrick's Gold. So he's not a bug guy or a gold bug guy. He is completely against gold in a normal market, and there's a reason for it. But right now, we're not in a normal market, and that's what that signals to me is, hey, get ready. You have to watch these guys and what they do with their actions when they invest, not their words. Okay? So that's really all I had for this video. I just wanted to cover my investing plan and why it aligns with kind of what they're talking about in this article, and why I'm shooting videos on blockchain and other alternative investment options there. So you guys have a great weekend. If you like what you're hearing, hit the subscribe button. Hit the like button as well. It helps with the YouTube algorithm. And we are one subscriber off from 800, so I'm looking at breaking that goal over the weekend. And with that said, I will talk to you guys next week. Thanks.